History rarely repeats identically, but it frequently rhymes with devastating precision. In both 1979 and 2026, the catalyst for a global economic paradigm shift originated in the narrow, volatile waterways of the Persian Gulf. However, the foundational fuel driving the global economy in these two distinct periods represents entirely different paradigms of systemic risk. While the 1980 crisis was a cyclical shock that could be cured by brutal monetary medicine, the 2026 crisis represents a structural trap. We are witnessing the collision of a historic energy shock with the terminal phase of a global fiat currency experiment. To understand the forward-looking trajectory of precious metals, the impending threat of hyperinflation, and the brutal reality of the 2026 market correction, we must first dissect the ghosts of the 1980 gold collapse and the men who broke the markets. We begin in the late 1970s, a period defined by the failure of Keynesian economic models and the devastating reality of stagflation, a toxic blend of stagnant economic growth and rampant inflation. This geopolitical earthquake triggered the second major oil shock of the decade, following the 1973 to 1974 Arab oil embargo. The immediate mechanical result was a decline in Iranian oil output by 4.8 million barrels per day, effectively removing 7% of world production from the market. However, the true economic terror was psychological. The physical supply disruption was vastly eclipsed by panic buying and widespread speculative hoarding. Consumers and corporations alike scrambled to secure reserves, effectively doubling the actual market shortage and pushing spot market oil prices to a then staggering $50 per barrel. Between April 1979 and April 1980, the price of oil more than doubled, violently injecting inflationary pressures into a global economy already reeling from a depreciating US dollar. The monetary policy of the era had fostered this vulnerability. Through early 1978, the Federal Reserve, led by successive chairmen who adhered to gradualism, maintained a highly accommodative stance in a futile attempt to combat rising unemployment. Arthur Burns, the Fed chairman from 1970 to 1978, had repeatedly failed to keep the federal funds rate high enough for long enough, a dovish timidity that allowed inflation to become entrenched in the psychology of the American consumer. By January 1979, inflation had accelerated to 7.7%, and the US dollar had lost 12% of its value against major foreign currencies over the preceding 3 years. The stage was perfectly set for a panic flight into hard assets. On February 28, 2026, the United States and Israel launched a massive, unprecedented series of surprise airstrikes across Iran. The operation resulted in the assassination of Supreme Leader Ali Khamenei and systematically decimated the Iranian military apparatus. In a televised address, the U.S. Secretary of War confirmed that over 15,000 enemy targets had been struck by the combined forces of the U.S. and Israeli air forces, reducing Iranian missile capabilities by 90% and effectively neutralizing their navy. However, the asymmetric retaliation from the Iranian regime was the weaponization of geography. Iran successfully closed the Strait of Hormuz, an act that immediately disrupted the fundamental arteries of global trade. The scale of the 2026 disruption makes the 1979 crisis appear almost localized by comparison. The blockade paralyzed the transit of approximately 21 million barrels per day. The closure effectively removed 20% of global seaborne crude oil, 20% of global liquefied natural gas shipments, and 1/3 of the global trade in urea fertilizer from the market instantaneously. Brent crude surged violently past $120 per barrel in the immediate aftermath, with macroeconomic models projecting a potential catastrophic climb to $190 per barrel by August if the blockade persists. Diving deeper into the granular mechanics of the 2026 shock exposes the fragility of modern just-in-time supply chains. Unlike the crude oil market, which is somewhat buffered by strategic petroleum reserves, the LNG market lacks deep structural storage. The disruption immediately threatened the global technology sector. In Taiwan, the Taiwan Semiconductor Manufacturing Company, which consumes roughly 10% of the nation's electricity, faced an existential threat due to the lack of imported LNG for power generation. Furthermore, 90% of the world's sulfur is a byproduct of oil refining. This sulfur is essential for creating the sulfuric acid used in semiconductor etching. The halt in refining threatened to stop semiconductor production globally, even if power could be maintained. Simultaneously, the blockade created a circle of pain for global logistics. The withdrawal of war risk insurance for maritime vessels and the spiking of shipping rates paralyzed container traffic. Diesel prices experienced a terrifying multiplier effect of 2.3 times relative to crude increases, while jet fuel premiums expanded by 150 to 200%, pushing prices to nearly $200 per barrel. The economic clock of war had begun ticking, creating a secondary inflationary shock that bypassed physical reserves and attacked the core of global manufacturing. Let us explore the psychological response of capital in the face of systemic currency debasement. The 1970s precious metals mania was a direct consequence of the ultimate monetary regime shift, the death of the Bretton Woods system. In August 1971, President Richard Nixon officially severed the US dollar's convertibility into gold at $35 per ounce, unmooring the global financial system and initiating the era of pure fiat currency. Over the subsequent decade, as inflation ravaged the purchasing power of the American consumer, gold evolved into a panic hedge, a primal financial scream against spiraling prices and thinning institutional trust. By January 1980, this fever culminated in gold spiking to a then unthinkable peak of $850 per ounce, representing an astounding 2,329% gain for investors who had held the metal since the Nixon shock. Conversely, individuals who kept their wealth in cash during that period lost 87% of their purchasing power to inflation. However, the most dramatic manifestation of this era's hard asset rush was engineered by the Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, Texas oil billionaires. Operating under the family ethos that a rich man is never rich enough, the Hunts had built a massive oil empire in Libya, only to see it nationalized and slashed following Muammar Gaddafi's 1969 political coup. Deeply paranoid about the declining purchasing power of the US dollar and the rampant inflation of the 1970s, the brothers sought a safe haven. Because US law at the time heavily restricted private citizens from freely owning large quantities of gold bullion, the Hunts targeted silver, an industrial metal they deemed vastly undervalued. What began as a strategic inflation hedge in 1973 rapidly mutated into an aggressive campaign to corner the global silver market and dictate its price. Through personal investments, family trusts, and heavy borrowing, the brothers amassed a staggering stockpile. They physically transported tens of millions of ounces of silver bullion via chartered aircraft, utilizing heavily armed convoys to secure the metal in Swiss vaults. By 1979, the Hunts partnered with wealthy Saudi investors to form the International Metal Investment Group. At the zenith of their operation, this syndicate controlled an estimated 42 million ounces of physical silver and commanded an astonishing 69% of the entire COMEX silver futures market. The psychological euphoria of this cornering operation was absolute. Silver prices experienced an explosive vertical trajectory, skyrocketing from $10 an ounce in the summer of 1979 to nearly $50 an ounce by early 1980. The hubris reached its apex when the Hunts seriously suggested reintroducing silver as a replacement for the US paper currency system. Fast forward to the hyper-modern era. The 2024 to 2026 precious metals rally mirrored the psychological fervor of the 1970s, but was driven by vastly more powerful structural forces. The new protagonists were not Texas billionaires, but global central banks. Throughout 2022, 2023, and into 2026, central banks, particularly in developing nations like China and India, engaged in an unprecedented hoarding of physical gold, fundamentally altering the market's supply-demand dynamics. This was a calculated strategy of de-dollarization, an effort to insulate sovereign wealth from the weaponization of the US dollar and the increasing geopolitical fragmentation of the world order. By 2026, global holdings of gold by the official sector surpassed 36,000 tons, approaching the all-time highs of 38,000 tons established in 1965 during the Bretton Woods era. In a stunning statistical reality, nearly 1 out of every 3 ounces of gold mined globally in 2022 and 2024 was vaulted directly by a central bank. Consequently, gold's share of global foreign reserves leaped to 20%, surpassing the euro and second only to the US dollar itself. As the 2026 Middle Eastern conflict erupted, retail investors, watching the systemic fragility of the geopolitical landscape, joined the rush. A phenomenon described by analysts as gold-plated FOMO swept through the retail sector, driven by a deep conviction in the debasement trade, the belief that fiat currencies were entering a terminal phase of depreciation. This potent combination of relentless sovereign accumulation and retail panic drove gold to meteoric new highs. From a starting price of $1,617 per ounce in October 2022, gold surged vertically, breaching $5,000 and eventually peaking near $5,600 per ounce in late January 2026. Silver, riding the coattails of gold and squeezed by immense industrial demand for photovoltaics and electronics, soared from its historic norms to an all-time high of over $120 per ounce. The psychological parallel between the two eras is profound. In the early phase of both rallies, investors bought cautiously, hedging against macroeconomic uncertainty. But as prices rose, confidence morphed into unyielding excitement, and eventually, into a dogmatic belief that prices could only move higher. This shift from rational hedging to speculative euphoria mirrors the exact sentiment that preceded every historical gold correction. The moment the market stops questioning the rally is precisely when the structural trap is sprung. Let's delve into the brutal mechanics of a monetary regime shift. In August 1979, President Jimmy Carter, desperate to combat the stagflation that was destroying his presidency, nominated Paul Volcker as chairman of the Federal Reserve. Volcker entered the role with a singular, uncompromising mandate: crush inflation, regardless of the economic collateral damage. By October 1979, inflation was running at a 9% annual pace, and the dollar was bleeding value internationally. On the evening of Saturday, October 6, 1979, Volcker called a rare, unscheduled press conference to announce a dramatic policy pivot. He declared an end to the Fed's previous strategy of gradualism. Instead of attempting to fine-tune the federal funds rate, the Federal Open Market Committee would now target the volume of bank reserves in the system. By strictly constraining the money supply, Volcker accepted that daily interest rates would fluctuate wildly. This was not a mere policy adjustment, it was a scorched earth campaign. The federal funds rate was allowed to rip higher, reaching an unprecedented 20% by late 1980. Prime lending rates exceeded 21%. The policy plunged the United States into a severe double-dip recession. Liquidity was instantly choked off. Unemployment skyrocketed to 10.8% by late 1982. The public backlash was immense. Angry farmers protested in their tractors at the Federal Reserve headquarters. Auto dealers sent coffins containing the keys of unsold cars to Volcker's office, and politicians threatened impeachment. Yet, Volcker remained immovable, firmly supported by Fed officials who argued that the surest way to destroy a democracy is to tolerate runaway inflation. The impact on the precious metals market was absolute devastation. The correlation between gold and real interest rates dictated the outcome. When inflation expectations were finally broken by Volcker's massive rate hikes, real interest rates swung from deeply negative territory to highly positive levels. Because gold yields no interest, it cannot compete for capital against risk-free government bonds offering high positive real returns. Gold's sprint to $850 in January 1980 was its last gasp. Within a month, the price gapped down, initiating a brutal bear market that saw gold plummet by nearly 60% over the following 2 years, bottoming near $298 by June 1982. For the Hunt brothers, the regime shift was fatal. The rapid rise in silver prices had alarmed regulators. The Commodity Futures Trading Commission and the COMEX, backed by the Federal Reserve, intervened to halt the manipulation. They adopted Silver Rule 7, which placed severe limits on the number of contracts a single actor could hold and drastically increased margin requirements. Stripped of liquidity by Volcker's high interest rates and unable to secure lenders willing to buck the U.S. government, the Hunt brothers' empire collapsed. March 27, 1980 became forever known as Silver Thursday. Unable to meet massive margin calls, the Hunt's brokers were forced to liquidate hundreds of millions of dollars in silver futures. The price of silver cratered, plunging from $15.80 to $10.80 in a single trading session, wiping out speculators and threatening to drag several major U.S. banks into insolvency. The brothers were ultimately forced to accept a $1.1 billion emergency credit line that required liquidating their positions and mortgaging their remaining assets, ending the greatest commodity corner in modern history. Fast forward to January 30, 2026. For months, the global financial markets had been piling into the debasement trade, driving gold to $5,600 and silver to $120 based on a singular assumption. The market believed that the U.S. administration would nominate a pliant, dovish candidate to replace Jerome Powell as Federal Reserve Chair. Investors expected the Fed to lose its independence, succumbing to political demands for rapid rate cuts, which would further weaken the dollar and ignite inflation. At 1:10 p.m. Eastern Time on Friday, January 30, 2026, the White House shattered this consensus by officially nominating Kevin Warsh as the next chairman of the Federal Reserve. A former Fed governor from 2006 to 2011, Warsh is infamous on Wall Street for his hawkish leanings and his principled resignation in protest over the Fed's quantitative easing programs. The market instantly recognized him as a regime changer. Warsh's monetary philosophy advocates for a smaller Fed balance sheet, a strict reduction in the communication of forward guidance, and a return to pre-2000 opacity, where markets must react to data rather than Fed signaling. Furthermore, Warsh operates under an AI productivity thesis, echoing the Alan Greenspan era, believing that artificial intelligence will generate structural productivity gains, allowing the Fed to maintain disciplined, tighter monetary policy without suffocating economic growth. The market reaction was a violent repricing of risk, resulting in a historic flash crash in the precious metals sector. Within hours of the announcement, the U.S. dollar index surged dramatically. Algorithmic trading programs and leveraged retail positions triggered a massive wave of forced liquidations. An estimated $5 trillion in market capitalization was wiped out across the precious metals space. Gold tumbled by more than 12% intraday, breaking precipitously below $5,000 to settle near $4,189 per ounce, its worst single-day decline since 1983. Silver, displaying its characteristic hypervolatility, experienced an apocalyptic 36% collapse, erasing all its year-to-date gains and plunging to $85 per ounce, explicitly mirroring the devastating price action of the 1980 Silver Thursday. Quantitative desks at major banks noted massive forced rebalancing in levered exchange-traded funds. The iShares Silver Trust suffered its worst day since 2006, with a staggering negative 13 Z-score move, while the SPDR Gold Trust endured a negative 9 Z-score crash. While the price charts of 2026 appear to trace the exact trajectory of 1980, the underlying macroeconomic bedrock is fundamentally different. Kevin Warsh may possess the ideological desire to be the next Paul Volcker, but he has inherited an economy that is mathematically incapable of surviving Volcker's medicine. The defining difference between the 1980 gold collapse and the 2026 market environment lies in a single, unyielding metric: sovereign debt. When Paul Volcker raised interest rates to 20% to crush the inflation of the 1970s, the U.S. debt-to-GDP ratio stood at approximately 30%. The federal government possessed the fiscal credibility and the balance sheet capacity to absorb the higher interest expenses required to service its borrowing. Volcker was a stern surgeon operating on an otherwise healthy patient suffering from an inflationary fever. By 2026, the patient is terminally fragile. The U.S. national debt has reached 100% of gross domestic product. The federal government is operating with budget deficits elevated at approximately 6% to 7% of GDP during peacetime, an historically anomalous and highly expansionary rate of deficit spending. This introduces the critical economic concept of fiscal dominance. In a healthy, traditional monetary dominance regime, the central bank operates with total instrument independence. It is free to raise or lower interest rates strictly to control inflation and maximize employment, while the fiscal authorities manage taxes and spending to ensure debt sustainability. In 2026, the global economy has crossed the Rubicon into fiscal dominance. The sheer scale of the government's debt burden dictates that monetary policy is no longer independent. When government debt is this massive, the central bank is inevitably forced to subordinate its inflation-fighting mandate to a new, desperate priority, containing the government's debt service costs to prevent a catastrophic sovereign default. The closure of the Strait of Hormuz is the match thrown into the powder keg. However, the energy shock is compounding existing severe domestic inflationary drivers. Macroeconomic models indicate that the U.S. faces intense stagflationary pressures. Radical shifts in immigration policy have dramatically tightened the labor market. The break-even employment level, the monthly job gains needed to keep unemployment stable, has collapsed from 150,000 in early 2024 to below 90,000 by mid-2025. This artificial restriction on labor supply in migrant-dependent sectors is forcing aggressive wage increases, pushing home healthcare costs up by 10% annually. Simultaneously, the delayed pass-through of sweeping global tariffs continues to elevate consumer prices, adding an estimated 50 basis points to headline inflation. Coupled with the 120-plus oil shock from the Iran conflict, inflation is virtually guaranteed to break back above 4% by late 2026. If Kevin Warsh attempts to execute his hawkish mandate by holding interest rates high or aggressively reducing the Fed's balance sheet to fight this inflation, he triggers the debt doom loop. With $39 trillion in debt, higher interest rates exponentially increase the Treasury's interest expense, which is already surging to record levels. To pay this massive interest burden, the government must issue even more debt. This torrential issuance of Treasury bonds crowds out private investment, starves the economy of capital, and floods the bond market with supply. The ultimate threat detailed by financial analysts is a buyer's strike in the U.S. Treasury market. Global investors, already participating in massive de-dollarization and shifting their reserves into physical gold, may simply refuse to absorb trillions of dollars of new U.S. debt at affordable yields. If the bond market freezes, a fiscal crisis ensues, leaving the Federal Reserve with an impossible binary choice. Option 1, the default crisis. The Fed maintains its independence and refuses to buy the bonds. The U.S. government defaults on its obligations, triggering an apocalyptic collapse of the global financial system and a catastrophic depression. Option 2. The inflation crisis, or hyperinflation. The Fed abandons its independence, pivots entirely, and digitally prints trillions of dollars to monetize the debt, acting as the buyer of last resort to keep the government solvent. Economic history provides a grim roadmap for the second scenario. When nations cross the threshold into explicit debt monetization due to fiscal dominance, the market rapidly bakes future inflation into its long-term expectations. This loss of faith in the currency's purchasing power is the mechanical genesis of hyperinflation. It is not merely a theoretical model. It is the exact sequence of events that destroyed the currencies of the Weimar Republic in the 1920s, Argentina, Zimbabwe in the 2000s, and Venezuela in the 2010s. In this scenario, government borrowing acts as a massive, regressive tax, transferring wealth away from the public by bidding up the prices of essential goods and services until the fiat currency loses all utility. The January 30, 2026 flash crash was a violent, necessary repricing of Federal Reserve independence risk. It flushed out leveraged paper market speculators and triggered algorithmic ETF liquidations. However, the fundamental, structural drivers that ignited the precious metals supercycle remain entirely intact and are actively worsening. To understand why gold will rebound, one must understand the breakdown of its historical correlation with real interest rates. For decades, the fundamental rule of gold trading was simple. When real interest rates went up, gold went down, because investors preferred the yield of government bonds. This relationship was governed by the 10-year Treasury inflation-protected securities yield. However, this ironclad correlation fundamentally broke down in 2022 when the Fed began aggressively hiking rates. Despite real rates rising significantly, gold refused to collapse. Why? Because in a regime characterized by fiscal dominance, sovereign debt fears, and global geopolitical warfare, investors and central banks begin to price in different risks. The dominant marginal buyers of gold are no longer Western retail investors trading on nominal yields. They are Eastern central banks hoarding physical bullion as a Tier 1 reserve asset to protect against the collapse of the dollar hegemony. This structural floor underneath the physical market ensures that the 2026 correction is merely an interruption, a clearing of the paper market froth, rather than the end of the bull market. Despite the shock of the Kevin Warsh nomination, the global consensus among the world's leading financial institutions points to an aggressive continuation of the gold bull market throughout 2026 and 2027. The Warsh mandate to shrink the balance sheet may cause short-term liquidity panics, but the mathematical inevitability of the U.S. debt burden ensures that his sound money vision will ultimately be crushed by the weight of Treasury issuance. Forecasting models from major banks explicitly outline this forthcoming reality. The underlying demand from central banks is projected to remain voracious, averaging around 585 tons per quarter. As physical supply remains strained against this sovereign demand, price targets have been heavily revised upward to the $6,000 to $6,300 per ounce range by year-end 2026. The analysis suggests that the market will undergo a period of severe whipsaw volatility. Investors should anticipate wild swings in precious metals as the Federal Reserve attempts to walk a tightrope over the abyss of a sovereign debt crisis. The 2026 energy shock has catalyzed inflationary forces that simply cannot be contained by interest rate manipulation. If the Strait of Hormuz remains closed, the subsequent raw material shortages will induce global recessionary forces simultaneously with hyperinflationary price spikes. The ultimate stagflationary trap. The 1980 Volcker shock successfully saved the fiat currency system because the system still possessed the fundamental balance sheet capacity to endure the cure. The national debt was low enough that the government could afford the high interest rates necessary to break inflation's back. Volcker's medicine was brutal, but the patient was ultimately resilient. In 2026, the Kevin Warsh nomination represents an attempt to perform that exact same surgery, but the patient is terminally compromised. Burdened by a debt-to-GDP ratio exceeding 100%, paralyzed global energy logistics, and a fractured geopolitical world order, the United States economy cannot sustain positive real interest rates for a prolonged period without triggering a sovereign default. The catastrophic flash crash of January 30, 2026 was merely the market's initial mechanical reaction to the ghost of Paul Volcker. However, as the structural reality of fiscal dominance sets in, over the coming months, the realization will dawn on global capital markets that the Federal Reserve must eventually capitulate. The Fed will be forced to prioritize government solvency over price stability. When that pivot occurs, and the central bank begins to monetize the debt to prevent a treasury market collapse, the next phase of the precious metals supercycle will ignite with unprecedented ferocity. Hyperinflation is no longer an abstract academic theory relegated to the history books of the 1920s. It is the mathematical consequence of unyielding exponential debt, intersecting with an intractable geopolitical energy shock. We are left with the ultimate law of capital preservation. In an era where trust in sovereign credit evaporates and fiat currencies enter their terminal phase of debasement, capital flows inexorably toward assets that carry no counterparty risk.